Imagine standing at a crossroads in your mid-20s, holding a sum of money that represents your hard work, your savings, and perhaps a little help from family. It is a pivotal moment that defines the trajectory of the next 40 years of your life. On one path, there's a house, a white picket fence, a yard, a place to call your own, the tangible symbol of success that society has sold you since you were a child. On the other path, there's a portfolio, a collection of digital stocks, bonds, and index funds that offer no immediate shelter but promise a future of limitless freedom. This is the ultimate financial dilemma of our generation. Do you buy a house in your 20s, or do you invest that money instead? Today, we're going to walk through both lives, minute by minute, year by year, to see not just where the money goes, but where your life goes. We are going to strip away the romance of real estate and the intimidation of the stock market to look at the raw, unvarnished truth of what these choices mean for your future, your stress levels, and your ultimate net worth. Let's start with the life of the homebuyer. If you choose to buy a house in your 20s, the journey begins with a rush of adrenaline and a crushing weight of debt. Let's say you're 25 years old. You have scraped together a $40,000 down payment. You find a modest starter home for $400,000. You sign the mortgage papers, and suddenly, you are responsible for a massive debt. But initially, the feeling is euphoric. You paint the walls. You host housewarming parties. You feel a sense of pride that renters simply do not feel. You're no longer throwing money away on rent. You are building equity. This is the narrative we are told, and for the first few years, it feels real. You watch the principal on your loan slowly creep down. You see the property market tick upward, and you think, I am a genius. But life as a homeowner in your 20s is rarely as simple as the magazines make it look. Because while your friends who invested their money are packing their bags for a month-long trip to Southeast Asia or moving to a new city for a better job opportunity, you are anchored. Anchored is the perfect word for it. You're geographically locked. If your boss offers you a promotion, but it requires moving to a different state, your first thought isn't opportunity. It is panic. You have to sell the house. You have to pay real estate agent fees, closing costs, and taxes. You realize that your asset is actually a giant anchor that prevents you from chasing the best version of your career. Then there is the hidden reality of maintenance. In your first year, the water heater breaks. That is $1,500 gone. 2 years later, a storm damages the roof. Insurance covers some, but not all, and there is the deductible. You spend your weekends mowing the lawn, cleaning gutters, and driving to Home Depot instead of building a side hustle or relaxing. You are house poor. You make good money, but you have no cash flow because every disposable dollar goes into the mortgage, the insurance, the property taxes, and the repairs. You are forced to keep a job you might hate because the mortgage must be paid. The bank owns your time until that debt is cleared. Yet, there is a psychological security that comes with it. You have a fortress. If the economy crashes, you have a roof over your head that no landlord can take away. You have stability, even if it comes at the cost of liquidity. Now, let's pivot and walk down the other path. Let's look at your life if you take that same $40,000 and invest it instead. In this scenario, you do not buy the house. You keep renting a nice apartment, perhaps one that is even nicer than the house you would have bought, because your monthly rent is lower than a mortgage payment would be. You take that $40,000 and you dump it into a low-cost, diversified index fund that tracks the overall market. Historically, the market returns an average of 8 to 10% per year over the long term. But the real magic happens with what you do with your monthly cash flow. Because you aren't paying for a new roof or property taxes or private mortgage insurance, you have an excess of maybe $1,000 a month compared to your homeowner counterpart. You automate that transfer. Every month, that $1,000 goes straight into the same investment account. In this life, your 20s look different. You're lighter on your feet. You're liquid. If a once-in-a-lifetime opportunity comes up to start a business or move to a thriving tech hub, you take it. You sign a lease termination notice, and you go. You aren't worrying about market conditions in your specific neighborhood. You are worrying about your personal growth and your income potential. While your homeowner friend is stressing about interest rate hikes, you're reading books on philosophy or learning a new language. Your net worth in the early years might be volatile. The stock market doesn't go up in a straight line. There will be years where your portfolio drops 20%. You have to have the stomach to watch your $40,000 turn into $32,000 without panic selling. This requires emotional discipline that homeowners don't necessarily need, because the home value is invisible until you sell. But if you stay the course, the mathematics of compound interest begin to take over. By the time you reach your mid-30s, the divergence between these two lives becomes stark. Let's look at the numbers. In the homeownership scenario, let's be generous and say your home appreciates at 3% a year, which is the historic average. You started with a $400,000 home. After 10 years, it might be worth roughly $530,000. You pay down a chunk of principal. Let's say you have $100,000 in equity. However, you also paid thousands in interest, taxes, insurance, and maintenance, money that is gone forever and cannot earn compound interest. Your net worth is tied almost entirely in a liquid asset in a single location. Now look at the investor. You started with $40,000. You added $12,000 a year, that extra $1,000 a month. Even with a conservative 7% annual return, after 10 years, you're looking at a portfolio worth over $200,000. But wait, you didn't have to pay for maintenance. You didn't pay closing costs. And perhaps most importantly, you were able to move to a city with a higher salary because you weren't tied down. Let's say that mobility allowed you to negotiate a 20% higher salary over those years. That extra income was also funneled into investments. Now your portfolio is closer to $300,000, and it is entirely liquid. You can cash out a portion of it without selling your home. You have options. As we move into your 40s and 50s, the gap widens into a chasm. The homeowner is likely looking to upgrade. They sell the starter home, pay 6% in realtor fees, pay closing costs on a new, more expensive house, and reset their mortgage clock. They are constantly upgrading their lifestyle, which means their expenses rise to match their income. They're trapped in a cycle of earning to pay for the shelter they live in. The investor, however, has been riding the wave of compound interest for 2 decades. Their portfolio is now generating significant passive income. In fact, the dividends and growth from their investments might actually be enough to cover their rent entirely. At this point, their housing is effectively free because their money is working for them. This brings us to the concept of rent is dead money. This is the biggest lie in personal finance. People say renting is throwing money away. But is it? If renting costs you $1,500 a month, but owning costs you $2,500 a month when you factor in interest, taxes, and maintenance, then renting actually saves you $1,000 a month. If you invest that difference, you are not throwing money away. You're paying yourself to live there. When you pay a mortgage, a huge portion of that payment in the early years goes straight to the bank as interest. That is the true definition of dead money. You are paying the bank for the privilege of using their money. The homeowner is the one throwing money away on interest and depreciation of the structure, while the investor is using their capital to acquire ownership in profitable companies that produce goods and services the world needs. However, we cannot ignore the psychological aspect completely. There is a peace of mind that comes with homeownership in your later years that is hard to quantify. If you invest and the market crashes the year you plan to retire, you are in trouble. But if you own a home, you have a place to live regardless of what the stock market does. The investor has to plan for rent payments in perpetuity, which means they need a larger portfolio to sustain them. The homeowner eventually pays off the mortgage, and their housing costs drop to just taxes and maintenance. There is a finish line for the homeowner. For the investor, the rent payment never goes away until they die. So, which life is better? It depends entirely on what you value more, roots or wings. If you value stability, if you want to customize your living space, if you want to know that no one can kick you out, and if you trust the real estate market in your specific area, buying a house might be for you. But you must accept that you are buying a lifestyle, not necessarily a superior financial investment. You are paying for the control over your environment. If you value freedom, if you want to maximize your wealth, if you want the ability to travel or change careers on a dime, and if you have the discipline to invest the difference every single month without fail, then renting and investing is the mathematical winner by a landslide. Let's zoom out and look at the end game. You're 65 years old. You're looking at retirement. In the homeownership scenario, you live in a house that is paid off. It is worth maybe $1 million due to decades of inflation. But you are asset rich and cash poor. You have $1 million tied up in walls and a roof. To get money to buy food or pay for medical care, you have two choices: sell the house or take out a reverse mortgage. Selling the house is traumatic. It is the home you raise your family in. A reverse mortgage eats away at your equity. You have liquidity risk. You have all your eggs in one basket. If the neighborhood declined over 40 years, your net worth suffers. In the investor scenario, you have a diversified portfolio worth perhaps $3 million. You have stocks, bonds, and perhaps real estate investment trusts. You can generate a safe withdrawal rate of 4%, which is $120,000 a year. You can pay your rent, travel the world, and leave a massive inheritance to your children. You never had to worry about fixing a roof. You never had to worry about a housing crash wiping out half your net worth because you were diversified across thousands of companies. You have total autonomy. But wait, the investor has to pay rent until the day they die. That is a risk. If rents skyrocket, it eats into your returns. However, owning a home does not eliminate the cost of housing. It just shifts it. You pay for the home up front with interest and maintenance. The investor pays for housing as they go with rent. Over a lifetime, the cost of renting plus the growth of the invested down payment and monthly savings almost always surpasses the equity growth of a home, primarily because homes are unproductive assets. They do not generate cash flow while you own them. They only cost money. Stocks, businesses, and dividends are productive assets. They pay you to own them. The decision in your 20s sets the compounding effect of your life. Buying a house is a deferral of gratification for stability. It is a conservative bet. Investing is a bet on your own adaptability and the growth of the global economy. It is a bet on freedom. When you're 25, you underestimate how much your life will change. You don't know who you will marry, if you will marry, how many kids you will have,